All right, welcome to week 9, everybody. I'm going to go ahead and get started here. And let's see, I did adjust the time for today, so I hope that didn't create any confusion, but hopefully we'll have some students joining, so I'm not just talking to myself. A couple things I want to talk about before we get into our new chapter. Last week, obviously, we had the midterm exam, so I hope that that went okay for you. If you haven't taken it, do so as soon as possible, since it was due on Sunday. And let's see, we had the video number 2 discussion. I am a little behind, so I've not yet gone through and responded. I will respond to each student's main post as soon as I can. So if you have not already received a response from me in that discussion, you will get one. I would say, maybe tonight, maybe tomorrow, but as soon as I can. Then I will also be grading that discussion as soon as I have a chance. The same goes for the personal progress journal. If you submitted a post to that, I will be issuing credit. And the way that that extra credit activity works, to get the full 1 point of credit, it requires posting, early in the course, another time before the midterm, and then a third time by week 12. So you get a little bit of credit each time for those posts. All right, so if there are any questions about any of that or anything else, let me know. I'm going to go ahead and close some of these tabs. And the other thing I wanted to mention here for this week, if you look at the Chapter 9 module, so if you scroll down to Chapter 9, the very first link in there is a survey. Please take a few minutes this week and complete the survey. It's anonymous, and it gives you an opportunity to give me feedback on how the course could be better. So please let me know your thoughts, and I do read every contribution, and I use that information to try to continually improve the course. So again, please do that this week. And that is about it. So we can go ahead and get into our Chapter 9. Now this chapter is on accounting for receivables. We're familiar with accounts receivable already. We know that if a customer makes a purchase and they don't pay at the time of purchase, then they'll be paying later, right? Hopefully. We'll talk about what happens when they don't pay. But in general, we call that accounts receivable because we expect to receive that payment on that customer's account at some point in the future. So we're familiar with that already. We're going to be digging deeper into that topic in this particular chapter. And the first exercise starts out pretty simple and straightforward. So let's just go ahead and get that one out of the way, and then I'll talk about some of the other aspects of this chapter as we get to them. My voice is a little scratchy, so I'll just do my best here. Hopefully you can hear me okay. So the first exercise, we have some journal entries. We're going to be doing a lot of journal entries in this chapter. This customer bought 200 pans at $35 per pan, and we're doing the accounting for the seller, the company. And so if we say 200 pans at a price of $35 each, that's $7,000 in revenue, and that's $7,000 of accounts receivable. And if we're using the perpetual inventory method, which is the common approach to inventory, then we have to keep track of the cost of that sale. Here we see the pans cost the company $21 each. So we take, how many was it? I forgot. 200 pans at $21 each. That's a $4,200 cost of goods sold. And that's also the amount of inventory we no longer have. Welcome, Jane. I'm on exercise number 1 for chapter 9, so you haven't really missed a whole lot. Okay, so now we've journalized the sale, right? Including the cost of the inventory. Then when the customer makes their payment, if you remember payment terms here, in this case, it's 210 net 30. So that means the customer gets a 2% discount if they pay within 10 days of the invoice. And even if they don't pay within 10 days, the net amount, the total that they owe is due within 30 days of the invoice, right? So 10 days from the invoice would bring us to November 18th. They made their payment on the 17th, so they get that 2% discount. And as you probably recall, we can take the total that they owe, their accounts receivable, multiply that by the 2%. Whoops, okay, let's try that again. 2%. And we see they get an $84 discount. Right? So that is a debit to sales discounts. The difference is the amount that the customer has to pay. So we take the original amount that they owed minus the discount, oops, 84, and we get $4,116. That is the amount they have to pay. Right?
Question on the accounts receivable. It's 7,000, not 4,000, right?
You're right. You're right. Thank you, Jane. I'm sorry, I'm a little tired today. I'm glad you're here because if you weren't, nobody would have pointed that out to me. So thank you. Yes, and that makes a lot of sense because the numbers did not look familiar to me. That looks familiar. So yes, okay, so we take the $7,000 account receivable times the 2% discount, which is $140, and the amount that they pay is $6,860. Okay, great. So that is the correct answer. Yeah, I was feeling like there was something wrong here and I was about to check the answer sheet just to make sure, but you saved me from having to do that. Okay. Very good. Let's go ahead and try number 2 now. So this is a little bit different because in this case, the customer is paying with a credit card. Now, there are 2 ways to journalize a credit card payment. One way would be to count it as an accounts receivable, but it's the credit card company that owes the money, not the customer. Because if a customer pays with the credit card company is going to send the money to the merchant or the seller, and then they're going to bill, the credit card company is going to bill the customer, right? And the customer is going to pay the credit card company. So if we do it that way, what we would do is set up an accounts receivable for that credit card company, and that's who we would expect to pay us. That is one way to handle a credit card transaction. The other way is we could just treat it like cash. And the reason for that is when you do accept a credit card payment, you typically get that money within a couple days that it gets deposited into your bank account by your merchant bank, the company that processes the credit card transaction. So some companies might just treat that credit card payment like it's cash. But for the most part, when we see these in this chapter, we're going to treat them like accounts receivable. So that's what we're going to do here. In this case, let's see, the amount of the purchase is $132,980. Okay, so that's how much the customer owes. But again, because they're paying with a credit card, going to count that as accounts receivable. And then we're going to put the name of the credit card company. And they just made this up. It's not a real credit card company, but we're going to put the name Standard. So that is the name of the credit card company that's going to pay us within a couple days the amount that's owed to us. However, no, I'm sorry. I made another goof.
Yeah, shouldn't it be the sales revenue?
That should be sales revenue. That should be sales revenue. Yeah. Thank you, Jane. Yes, so that was the amount of the sale. Now the accounts revenue, the accounts receivable, man, I just, maybe I need to reschedule. Okay. The accounts receivable, you'll notice, is different from the sales revenue, right? And the reason for that difference is because the credit card company charges a fee. So as a merchant, as the seller, if I want to accept credit card payments, I have to realize that's going to cost me some money. In this case, they tell us the fee is 4%. I think these days, I'm not really sure what the going rate is, but I think it might be a little bit lower. It kind of depends though on the credit card company, and it also depends how much volume you do as a seller. The more transactions you do, the better discount, the better rate that they're going to give you on the fee. So in this case, it's a 4% fee. So the way we calculate that is we take the total amount of the sale times the 4%, and that's where this came from. And that is going to be a debit to credit card expense. Okay. And so that just comes out of what the credit card company is going to pay us. So we could take the amount of the sale minus the fee, and the difference is the accounts receivable that the credit card company will pay. Did I get that right, Jane?
It's fine.
Okay. All right. And then again, we do have to record the cost of goods sold for the inventory and merchandise inventory, right? Okay. Then the credit card company pays us. So again, they only owe us this amount. So this is where we credit their accounts receivable because they have paid us, and we would debit cash because that's how they paid us. Okay. So that's how we're going to be handling credit card transactions. Again, you could just treat them like cash. And if you did it that way, well, I think there might be one exercise where we do treat it as cash. But anyways, if you do it that way, you would still take out the credit card fee because you still are going to have to pay that to the credit card company. Or technically, you're just not going to get that money. And so you would still journalize it the same way here. The only difference is this first account would be cash. And then you wouldn't have a subsequent transaction because you already recorded that the money came in. Now, the problem with that is, what if the money doesn't come in, right? What if you record it as cash and then the credit card company never gives you that money? Your books suggest that you already got it. So that would make it a little complicated. And that's why generally we're just going to do it this way. Makes everything more clear. Okay, so feel free, Jane, if you have any questions at any point, please do let me know. And let's go on to number 3 here. So here the company sells 540 units of their product. Sales price is $7 and the cost is $4 per unit. So the first thing we're going to do is we're going to journalize. Oh, yes. Okay. The first thing we're going to do is journalize the transaction. But in this case, the company is paying with an in-house account. Okay. Basically, that means it's an account receivable. So it's basically like the customer said, okay, I want to buy these 540 card decks, charge it to my account. Whether it's a consumer or if it's a business-to-business transaction, doesn't really matter. We just treat that like accounts receivable. So let's go ahead and just journalize that transaction. 540 units of product at $7 each, $3,780. That's how much the customer owes. We're going to send them a bill. We have to also record the cost of the merchandise. So 540 units at $4 each is $2,160. Now, sometimes companies have their own credit cards. So if you open up an account with that company, they might give you a card you could use for purchases only at their store. And then whenever you use their card at their store, it's basically just an accounts receivable. They wouldn't have a fee because it's their own card and they're just, you know, they don't have to pay some other company a fee. Now, where it gets into a more complicated area, let's say you go to a store and you open up an account with them and they give you a credit card to make purchases, but that credit card says Visa on it or some other credit card processor's name. Well, in that case, it looks like it's the store's card, but it actually might be getting processed through some third party. So that gets a little complicated. We're not really going to see any situations like that we're going to have to do here. So in this first situation, it was an in-house account. We just treat that like accounts receivable. In part B, it's a third-party credit card. So the same customer making the same purchase, that sale is going to be sales revenue. This time, again, we're going to journalize it as accounts receivable, but because there was a credit card company that is going to be paying, it's the credit card company's account receivable, right? And they're going to bill the customers separately. And of course, we do have to take out the fee. There is a 2% fee in this case. So we would take the amount of the sale times 2%, 75.60. So that's where this comes from. And again, that is a debit to credit card expense. And if we add up the debits, they equal the credit, right? The last part of the transaction is exactly the same: debit to cost of goods sold, credit to merchandise inventory. Okay, so that's all we have to do for part B. Okay, next would be exercise 4. All right. All right, this is a large purchase, $130,900 is how much the customer owes. Let's see, what is the first transaction here? Okay, yeah, it's the sale. Okay. Okay, so here's the sale. And the customer is going to pay us later, so it's an account receivable. Okay, nothing unusual there. Now, normally the way it works with bad debt, with customers not paying what they owe us, normally under GAAP, what you would do is estimate what your bad debt's going to be. So you would look at your last year's worth of sales that were made on account, and you would apply a percentage that you think is not going to get paid. Or you could look at your accounts receivable and apply a percentage that you think is not going to get paid. You have 2 different methods. And by doing that, you're estimating how much of last year's sales you're not going to collect in the coming year. And that's what GAAP requires, that we estimate it. When you decide an actual customer is not going to pay you, then you take that out of the estimate. Okay, we'll learn how to do that a little bit later. In this particular example, that's what's happening. It says here, let's see, the company determined that Mr. Jenkins' account was uncollectible and wrote off the bad debt. Okay. Now, the reason we have to estimate what the bad debt's going to be is it then gives the investors and stakeholders that are looking at the financial statements an idea of what we expect the bad debt to be. Otherwise, they wouldn't know. They would think, oh, there's no bad debt indicated here, so they expect to collect all the money. So to give them a more accurate picture of our expected collections, we have to estimate it. If you are a small company, perhaps that doesn't have to follow GAAP, then you could just not do an estimate, and just as you have bad debt, then you write it off. Okay, but for GAAP, just know we make an estimate. So what's happened here is, well, this is kind of an exception, because this would be a company that's not following that GAAP procedure. So, and I think it explains it. Yeah, it does say here that this company rarely extends credit directly. So they're using the direct write-off method. So again, we normally wouldn't do this. What they're doing when they decide that Mr. Jenkins is not going to pay, at that time, that's when they are determining that it is bad debt. So they're wiping out Mr. Jenkins's accounts receivable and recording it as bad debt. Again, this is abnormal, okay? But that's what it says to do in this particular exercise. Then what happens is Mr. Jenkins, a couple months later, ends up paying us. So even though we had written it off as bad debt, which, you know, is an expense and therefore reduces our tax liability on income taxes, even though we had done that, he paid us. So now we have to reverse that transaction. So from September 4th, we have to do the exact opposite. We have to go ahead and restore his accounts receivable and take off that bad debt expense. And then we go ahead and process his payment. Here's the money that we got. It's a debit to cash. And then now he's paid off his account receivable. So this is a little bit odd, because on the same day, December 3rd, we restored his accounts receivable, and then we cleared it out again by processing his payment. The reason we do it that way is so that there's a clear record. So anybody looking at this history can see, oh, we made a sale on April 2nd. We wrote off the bad debt on September 4th. We reversed that on December 3rd when we got his payment. So you see a clear history of what happened. Okay. So that's what we have to do for that exercise. And as you notice, it's the same amount for all four of these transactions. Of course, the only difference was the cost of the inventory. All right, so if there are no questions, we will move on to number 5. Okay, so now this company is doing what you're supposed to do under GAAP, which is they make an estimate of what their bad debt is going to be. There are 3 ways you could do that. There's what's called the income statement method, and it's called that because you base it on net credit sales, which you'll find on an income statement. There's also the balance sheet method, and that's based on accounts receivable, which you'll find on the balance sheet. And the third is the aging of receivables method. And with that, you take your accounts receivable, but you break it down by how old the debt is. So you look at a specific period of time that your accounts receivable came from, and see how much is that from that period of time. And then based on past performance, what percentage of those customers do we think are not going to pay us? And then you look at the next older period of time and figure out what percentage of those accounts receivable are not going to pay. So anyways, we'll get to an example like that. But the basic concept is there are three ways, and in this example, they're using the income statement method. So what we need to do is take the credit sales, the total amount that we sold where the customers have not yet paid us. We're going to multiply that by a percentage. Now that percentage, again, is based on past performance. So we would look at previous years and see what percentage of our net credit sales were we not able to collect. And then that's the percentage we would use. So in this case, it's 3.2%. Okay, so the first thing we're going to do here is record our estimate of bad debt. So we take the net credit sales from the income statement, multiply that, whoops, shoot. Okay, let's try that again. Net credit sales, multiply that by the 3.2%. We get this 24,744.64. So now we see where this came from. And the way we journalize it, it doesn't matter which of the three methods you use. You always journalize it as a debit to bad debt expense and a credit to allowance for doubtful accounts. Okay. Now, we didn't see allowance for doubtful accounts in the last exercise, right? In this last one, the bad debt was written off directly to the customer. But as I mentioned, that's not the normal way you would do it under GAAP. What we're supposed to do is estimate the bad debt, and we record it as allowance for doubtful accounts. Now, that account that we're crediting is a contra asset account. It reduces the value of our assets. So kind of like if you remember back to depreciation, when we record depreciation, which is an expense, we would credit accumulated depreciation, which was a contra asset account, right? And then the way we figure out the net value of our assets is we take our assets minus the accumulated depreciation to get our net assets, right? Gross assets minus accumulated depreciation equals net assets. Well, it's the same idea here. We take our accounts receivable minus our allowance for doubtful accounts, and that gives us our net accounts receivable. Okay, so in other words, how much of our accounts receivable we really think we're going to be able to collect is our net accounts receivable. So this is how we record the bad debt. And then what we're going to do anytime we do have bad debt associated with a particular customer, instead of doing what we did in the last exercise, we're going to apply it to this allowance for doubtful accounts account with a debit. Okay, and in fact, we see an example of that. On February 5th, we decided that our client, Moeller Corporation, who owes us $1,330, we decide they're not going to pay us. So what we would do, we would go ahead and clear out their account receivable, and we would debit allowance for doubtful accounts. So our allowance for doubtful accounts is going down. In other words, that estimate of how much money we're not going to collect out of accounts receivable is going down by this amount that was actually not collected, right? And if we perfectly estimated our bad debt, then at the end of the period, our allowance for doubtful accounts would have a zero balance. Okay, I said that a little too fast. If we perfectly estimated our bad debt at the end of the period, our allowance for doubtful accounts would have a zero balance, right? But that basically doesn't happen. So at the end of the period, we typically end up with either a credit balance or a debit balance in allowance for doubtful accounts. And we'll learn later how we handle that. Now, in this exercise, the customer then makes a payment. We gave up on the customer, but you know what? A couple months later, they came through and they made a payment. So again, just like last time, we have to reverse that last transaction. So we're going to restore their accounts receivable. And then we're going to process their payment and wipe out their accounts receivable once again. When we restore the accounts receivable, we are reversing the allowance for doubtful accounts transaction, right? Because we thought that money was never going to come in, but it did. So we have to restore that back as part of our allowance for doubtful accounts. And we also have to process, of course, the cash that the customer paid us. So when the customer payment comes through, we reverse the write-off, and then we process their payment. Okay, so that's all we have to do there for exercise 5. Let's go to number 6. This company uses the balance sheet method for estimating their bad debt. Okay, so that is based on the accounts receivable. And again, we have to apply a percentage. In this case, happens to be 3.2% again, but we're going to multiply that by the accounts receivable. So we take $299,420 times 3.2%, $9,581.44. And again, regardless of the method that you use to do the estimate, it's always a debit to bad debt expense, credit to allowance for doubtful accounts. Okay, let me double check that number. Let's see, that looks good, okay. Then what happens on November 22nd, we decide that Angels Hardware, one of our customers, is not going to pay us the $3,650 that they owe us. So again, we're going to go ahead and debit allowance for doubtful accounts, because that's money that we know for sure, or we believe for sure we're not going to get. So we're going to go ahead and take that out of our estimate. And we get rid of that customer's allowance for doubtful accounts. Then, just like before, the customer unexpectedly pays us. So we have to reverse that last transaction to restore their accounts receivable. And then we go ahead and process their payment and clear out their accounts receivable once again. Okay. Right, so number 7 here, this is the aging method. Again, all we have to do is the accounts receivables broken down into different categories. So this company looked at accounts receivable that are up to 30 days past due. Another category is 31 to 90 days past due, and another one is over 90. So the company gets to decide what categories and what bad debt estimation method they want to use. You could use whatever method you think is most accurate, or in some cases, maybe even what's most beneficial for your company. We'll talk more about that later. So in these 3 categories, we see how much accounts receivable exists in each category. And then based on past results, what is the percentage that we think is not collectible? And then all we have to do is you take the amount times the percentage, So 6,764 is the amount we're estimating we're not going to get from accounts that are up to 30 days past due. Then in the next category, 5,156.80. And in the last category, 8,202.90. Let's add them all together to get a total. And it looks like 20,123.70. Okay. If I calculated that all correctly, that is what we are going to journalize. Let me make sure. Looks good. So that's what we're going to debit to bad debt expense, credit to allowance for doubtful accounts. Now this method, because we're breaking it down into these multiple categories, is generally going to be more accurate in terms of estimating the bad debt. Because again, with the balance sheet method, you just take your total accounts receivable at the end of the year, multiply it by a percentage. So you don't really know in that total accounts receivable, is that recent debt? Is it really old debt? So it doesn't take that into consideration. Whereas by breaking it down into aging methods, aging categories, it does take that into consideration. Same thing with net credit sales. That's just it's a single calculation, so it's not as detailed as what we get here. So the more accurate estimate is probably going to come from the aging method, but obviously it does take a little bit longer because you have these categories. Great, let's go on to number 8. Oh, now we're going to get into ratios. Okay, these are pretty simple and it's going to go pretty quickly here. So there are 2 ratios we'll be learning about. One is the accounts receivable turnover ratio. And that basically tells us if this is our credit sales, this amount, and this is our accounts receivable, how many times does accounts receivable fit into our net credit sales? Or how many times bigger is our net credit sales than our average accounts receivable? Okay. And the way you calculate it is pretty simple. You take your net credit sales, divide it by your average accounts receivable. And if you're wondering, well, how do you find out your average accounts receivable? Well, the way we do it, it's not the most accurate method in the world, but this is the way we do it. You take your beginning accounts receivable, add it to your ending accounts receivable, and then divide by 2. Okay, it doesn't really give you an average based on your daily accounts receivable, but it does, gives you just a rough estimate. Okay, so that's what we're going to do here. We need to figure out this company's AR, or accounts receivable turnover ratio, for 2 different years. We're going to start with 2018. So first thing, well, let me back up. The formula says net credit sales divided by average accounts receivable. But the first thing is we have to figure out what that average accounts receivable is. Because here they only gave us ending accounts receivable. Now, if you remember, the end of one period is the beginning of the next, right? So the ending accounts receivable in 2017 is our beginning accounts receivable in 2018. So we're going to add 2017 plus 2018 ending accounts receivables. Then we're going to divide by 2. And that's what we're going to call our average accounts receivable. Okay. Then we are going to divide net credit sales by this number. And we get 2.03. We'll do the same thing for 2019. So now we need to add up 2018 and 2019 ending accounts receivable. Divide into net credit sales. And we get 2.02. Okay, so what that means is our net credit sales each year are about 2 times as much as our average accounts receivable. That's not great. You know, if we sold $700,000 that our customers didn't pay for at the time, but half of that basically hasn't been collected, you know, that's not that good, right? Because this is looking at a whole year. So an AR turnover ratio of 2 is not that good. You want the number to be as high as possible, because remember, it's accounts receivable, average accounts receivable in relation to net credit sales. So the more your sales and the less your accounts receivable, the more your turnover ratio is going to be, right? The more times that number is going to fit in there. So you really want as high of an AR turnover ratio as possible. To answer this last question here, what do these outcomes tell a potential investor? We could say the company's AR turnover ratio is very low and actually declined a little in 2019. So the company might want to find a way to collect some of that money that's owed to them. And maybe going forward, try to get more customers to pay earlier or at the time of purchase, right? Because that frees up our cash flow if we've got money coming in faster. So that's how you do your AR turnover ratio. Now, number 9 is based on the same data, same company, but we're going to figure out a different ratio. We're going to figure out number of days sales in receivables. So in other words, the average amount of accounts receivable is equal to how many days worth of sales. And the way we calculate this is pretty simple. We take 365, the number of days in a year, and we divide it by the AR turnover ratio. So for 2018, we take 365 divided by that 2.03 that we calculated earlier, and we get 179.80 days. And for 2019, again, we take 365 divided by 2.02, and we get 180.69 days. Now, this number you want to be as small as possible because you want fewer days worth of sales sitting out there in accounts receivable. And there is an inverse relationship here. So as your AR turnover ratio goes up, your number of days sales is going to go down. What do these outcomes tell a potential investor? So it tells us 180 days is about 6 months, right? So there are around 6 months worth of sales in accounts receivable. So the company should try to collect funds more quickly. And again, there wasn't a huge change, but it did get a little bit worse in 2019 compared to 2018. Basically, took a day longer to collect. Okay, so with number 10, this is similar. What we're going to do is figure out the AR turnover ratio and number of days sales and receivables for 1 year. And then we're going to compare it to this company's industry that they're in, because the industry average can be calculated and lets you compare to the industry. Okay, so let's try that. Let's see. Okay, so we have net credit sales is this number. Beginning AR is this number. And ending AR is this number. Okay, oops. So first we need to find our average accounts receivable. So we add beginning plus ending, divide by 2. Then we're going to take our net credit sales and divide by the average AR. And we get 2.37. Okay, so our net credit sales are 2.37 times as much as our average accounts receivable. We divide that number into 365. We get 154 days, so that's our average number, our number of days sales and receivables. And if we compare that with the industry has 2.6 AR turnover ratio, which is better than ours. However, number of days sales for some reason is 180 days, which is worse than ours. So what does it tell us? Our AR turnover ratio is not as good as the industry's, but our number of days sales in AR is better than industry. And we could also say that we should try to collect more quickly because again, 154 days, that's still like 5 months of sales sitting out there in accounts receivable. Be nice to collect that money quicker. Now, I'm going to be honest with you. I don't really understand how we could be doing better in terms of number of days sales and worse in terms of AR turnover. That doesn't really make sense to me. Tried to figure it out. Maybe there's an answer based on the volume of sales different companies do in the industry or something, but I don't know. I don't quite get that. But it doesn't really matter. To solve the exercise, well, we just have to apply the formula. So let's not overthink it. And let's move on to number 11. Okay, so here we're doing an aging activity, and it's pretty simple. The first set of tables is the question, but we're just going to go down to the second set, which is the solution. And we're going to say, okay, the company's original aging categories were 0 to 30 days, 31 to 90, and over 90. And then they modify those categories. And therefore, the amount of accounts receivable in each category is different. And now, so what we're going to do is multiply the amounts by the percentages, look at the old approach versus the new approach, and see the difference. Okay, so again, we take the amount from the old category for 0 to 30 days, multiply by 8%, which brings us to $4,000, right? 30,000 times 15% is 4,500, and 15,000 times 30% is another 4,500. We add those three together, and that's a total uncollectible estimate of $13,000 using the original categories. With the new categories, we end up with 6,400 here, 1,500 here, 1,500 here, and that gives us a total $9,400. of estimated bad debt using the new categories. So what is the difference between these two uncollectible amounts? Well, if we take $13,000, the original estimate, subtract the $9,400, the new estimate, it's a difference of $3,600, right? So our uncollectible estimate went down by $3,600. How will this impact net income and accounts receivable? Okay, so net income is revenue minus expenses, right? And bad debt is an expense. So if our expense goes down, our profits will go up. So net income will increase. And also, remember how I said our net accounts receivable is our gross accounts receivable minus our allowance for doubtful accounts, which is based on our bad debt estimate. Then that gets us our net accounts receivable. So if our bad debt estimate goes down, that also means our net accounts receivable goes up. So our answer here is net income and net accounts receivable will both increase from the decreased bad debt estimate. Okay, hopefully that made sense. Okay, shall we move on? Let's see, we've got a few more exercises here. And we'll move on to the problem set. Okay. Number 12. So this company, we have to first figure out their bad debt estimate for 2018. Now, there are a couple exercises here where they just put a whole bunch of information. We just kind of have to dig through it and look for the information. So bad debt estimate for 2018. Here it tells us that the company uses the income statement method and they use 5%. So the income statement method is based on net credit sales. Here we see their net credit sales for 2018. And that number is what we then multiply by the 5% to get the bad debt estimate. 28,350. Okay. Then for part B, it says we need to figure out their 2019 bad debt, but they're switching from the income statement method now to the balance sheet method at 7%. So for the balance sheet, that means we need to find the accounts receivable. And here it tells us accounts receivable balance is $600,000 for 2019, right? So we take that 600,000 accounts receivable balance times the 7% we were given, and we get $42,000 of bad debt. Now, the last part of this exercise, we're going to compare the bad debts for the two different years. It was higher in 2019, right? So what is the benefit of our bad debt being higher? Jane, if you have an answer, feel free to let me know. But why would it be a good thing for bad debt to be higher?
Is it because net income will reduce?
Yes, and therefore, if our profits are lower, then what's the benefit?
It looks better to investors or people that want to invest?
Well, no, you would want the net income to be higher for the investor's sake. But when the net income, and I know I put you on the spot here, but when the net income is lower and you have less profit, you pay less in taxes.
Oh.
So that's the benefit, yeah.
Okay.
So in this case, the higher bad debt leads to less profit, and the benefit is lower taxes. Lower income taxes, I should say. Okay. Now for exercise 13, this one's very similar. In 2018, they are using the balance sheet method at 8%. So we need to find accounts receivable for 2018, and they give us this amount here. Oops, yeah, that's right. Okay, so that's their accounts receivable times the 8%. So 54,000 is their bad debt estimate for 2018. Then in 2019, they're switching to the income statement method. Now, you can switch methods. GAAP allows us to use income statement method, balance sheet method, or aging method, whichever we feel is most appropriate. I would say ideally you'd use the one that really gives you the most accurate estimate of your bad debt, but sometimes a company might want to just manage its earnings. Maybe they want to look less profitable and pay less in taxes, or they want to look more profitable and look better to their investors. So you probably wouldn't want to change it every year and use a different method every year. I would think that would look a little suspicious to the IRS. Even though it's not illegal, they would be like, what are you doing here? So I would say the better bet is probably just to find the most accurate approach, the one that gives you the estimate that's closest to your actual bad debt every year, and stick with that. But in this case, the company is switching to the income statement method at 6% in 2019. So we have to get their credit sales up here for 2019, which is 802,670, and that is times the 6% we were given. That gives us 48,160.20 cents. So in this case, our bad debt went down. That causes net income to go up. So the benefit is the company appears more profitable. I'm not sure if that's correct grammar, due to the increased net income. Okay, so that is number 13. And for 14, we're getting back to journal entry. Let's see, let's move this down a bit. Okay, a customer makes a $480,000 purchase. And signs a note. Now, that's understandable. If you've got a customer making $500,000 purchase almost, you probably want to have something in writing, not only indicating that they promised to pay by a certain date, but also how much interest you're allowed to charge them in the meantime, because that's a lot of money to be waiting to collect from your customer. So in this case, we had the client sign a note. The note says there's a 13% annual interest rate. It's a 24-month maturity. That means the principal, the amount that the customer owes, is due in 24 months. And the interest in this case is due at the same time. Sometimes the person or the company issuing the note, maybe they want periodic principal payments, maybe they want periodic interest payments. But in this case, it's all going to be due at the end, the interest and the principal, which is a little risky for us to wait 24 months to collect $500,000. But on the other hand, we get 13% of interest per year. So the first thing we need to do is journalize the sale and the issuance of the note. And that is pretty simple. It's a debit to notes receivable. and a credit to sales revenue. Okay, that's all we have to do for that first transaction. Well, yeah, what did we sell in? I guess it's some kind of hardware. So normally we would put the cost of goods sold as well, but I guess in this case, we don't have to worry about that. Then at the end of the first year, we have earned 1 year's worth of interest, right? The sale was made on New Year's Day, January 1st. And at the end of the first year, that's a full year that's gone by, we've earned 1 year of interest. So we're going to take the $480,000 of principal times the 13% interest rate. And we see that the client owes us $62,400 of interest. However, we're not expecting them to pay at this time. So we're going to collect that later. So it's a debit to interest receivable because we're going to receive that money later. And it's a credit to interest revenue because we have earned that interest. Then another year goes by and the customer makes their payment. So they have to pay off the principal, the original note. They have to pay off that interest receivable from the first year, but there's another $62,400 of interest due from the second year. So we have to go ahead and credit that to interest revenue, just like we did in the first year, because we've earned now a second year worth of interest. So when the customer makes their payment, they have to pay 2 years of interest plus the $480,000 principal. So that's a total $604,800. Okay, so that's how much cash we receive, and they've paid off all the principal and interest. So that's how we do that. Number 15 is similar here. We issued a note to the customer, it doesn't give us the name. So we're just going to put debit to notes receivable, credit to sales revenue. Now, in this case, the customer did not pay when they were supposed to 2 years later. It also says interest has not been recognized. I don't know why we would not have recognized the first year's interest, but we'll just go with it. So after 2 years, in this case, we did record cost of goods sold. Okay, so the original sale looks like this. Okay, debit to notes receivable. The rest of it just looks like a normal sale. Then after 2 years, the customer has not paid. So what we're going to do is the principal that they owe us is now going to be due, as well as any interest that has accrued. And because they dishonored the note, we're going to convert it to an account receivable. So this is kind of interesting because if a customer starts off with an account receivable and they don't pay it, you can then negotiate with them that we're going to turn it into a note and you have to pay us interest. But then if they don't pay the note, you revert it back to an account receivable and you go after the customer and try to collect the money. So sometimes you convert from accounts receivable to a note payable or note receivable. Sometimes you convert from a note receivable to an accounts receivable. It can go both ways. In this case, we're converting it from a note receivable to an account receivable. We see this is the amount the customer owes in principal. This is the amount of interest Now, again, we are not applying this interest during the loan. We waited until the end. I think they journalized this as interest income, but I'll double check it. And now the customer has an account receivable. Okay, so let me double check on this one. This is number 15. Oh, they call it interest revenue. Okay. Interest income, interest revenue, it's pretty much interchangeable. So I've seen it both ways. Okay, so again, the principal got cleared out. The customer no longer owes us this principal. The interest has been applied for 2 years. Let's look at the calculation there. It was $390,500 of principal times a 5% interest rate times 2 years. So that's where 39,050 came from. We add those together, and now that's a total that the customer owes us. It's now an account receivable. If they don't pay within whatever period of time we've given them, then we might write it off as bad debt. We might sell that debt to another company, which actually I think we're going to see in exercise 16. But it's not going to stay on our books forever as an accounts receivable. There is one other thing I wanted to mention too. In these cases where we're applying interest, so far it's simple interest. And I think the whole chapter, it's just simple interest. Sometimes there's compounding interest, which means whatever interest was charged in the first period, if that has not been paid off, you then pay interest on that interest in the next period. And so it compounds and it just gets bigger and bigger and bigger. But we don't really have to worry about that because we're using simple interest for these exercises. Okay, we're at the last exercise here, and then we do have a couple problems, 4 problems we'll look at. So here, let's see, we issued a note to a customer, $120,250. So here's the original transaction, just looks like that. Then after 9 months, it was a 9-month note. So that means it matures after 9 months, and that's when the customer has to pay. It was a 9.6% annual interest rate. Now keep in mind, that's an annual interest rate, but the loan is only for 9 months. So we'll talk about how we figure that out, how we figure out the amount of interest that's due. So let's go ahead and calculate that actually. After 9 months, the customer owes us the principal. Then they also owe us the interest. So we take the principal times the interest rate times the number of months, which is 9, and then divided by the number of months in a year, which obviously is 12. And that gives us the interest for that 9-month period. Okay, so I think we might have done that in a future, there goes my brain again, in a previous chapter, but just to recap, if you're applying interest on any period other than a year, you take the principal times the annual interest rate times the number of months you're applying interest for divided by 12. Principal times interest times the number of months divided by 12. And that's what we did here. So now the client owes us that interest plus the principal. That's a total $128,908. Okay. So since they didn't pay within that 9-month period, we went ahead and wiped out their note receivable, added the interest, and converted that to an account receivable. And then the following month, we decided to sell that account receivable to a factoring company. Now, the way that works is the factoring company gives you money up front, but only a small percentage of the bad debt. So it's better than getting nothing, but it's not that great. So if the amount that is owed to us is $128,908, that gets wiped out off of our accounts receivables when we factor, when we sell this to a factoring company. And in this case, we sold it for 25% of its value. So we take the total times 25%. 32,227 is all we're getting. Again, it's better than nothing. The difference between what we were owed and what we got, we're writing off as a factoring expense. Oh, that's not right. Okay, 96,681. Okay, so basically factoring means the company that's buying that bad debt from us is paying us just a fraction, right? So we're factoring how much is due to us and how much goes to them. And then they're going to go out and try to collect the full amount. They might even add their own fees to it. I'm not sure if that's legal, but I know that sometimes they'll do that. They try to add fees and additional interest. So they're going to go out and try to collect at least the amount that was owed, and they only had to pay us $32,000. So they might make $96,000 or more if they're able to collect money from the customer. Okay, and let me double check those numbers here. Yep, they look good. So now let's go on to the problem set. Okay, chapter 9. We're going to do 3, 7, 8, and 11. If I remember, oh, close. 4, 7, 8, and 11. Okay. Let's go to number 4. Okay. Is that right? I'm going to double check that. Let me just double check and make sure I put the right problems there. This is 4, 7, 8, and 11. Okay. All right, let's go ahead and start with number 4 then. Okay, so here we see the credit sales for the company. Here we see their accounts receivable. For credit sales, the income statement method, they use 2.3% to calculate bad debt. For the balance sheet method, they use 3.6%. Again, you can only use one at a time, but these are our 2 options. And what we have to do for A is record the bad debt using the income statement method. So again, we're going to take credit sales or net credit sales and multiply it by the 2.3% we were given. That comes out to $19,812.89. Okay, so again, it's a debit to bad debt expense, credit to allowance for doubtful accounts, regardless of the method that you used. Now, if we use the balance sheet method, then we take 488,000 of accounts receivable times the 3.6% percentage. and we get 17,568. Let me just double check those numbers before we proceed here. Yep, looks good. Okay. Now, C says, assume there was a previous debit balance and allowance for doubtful accounts of 10,220. So it's a debit balance and allowance for doubtful accounts. Sorry, my mouse cursor is disappearing on me. Debit balance, there we go. 10,220. And we're told here to record the year-end entry for bad debt using both the income statement method and then using the balance sheet method. So you might recall I mentioned earlier, when we estimate bad debt, we credit allowance for doubtful accounts, and then when we actually write off bad debt for a particular customer, we debit allowance for doubtful accounts. And if we perfectly estimated, then at the end of the year, we would have a balance of 0 in allowance for doubtful accounts because our original estimate completely matched what we actually wrote off. But again, that really doesn't happen. So you're typically going to end up with either a debit balance in allowance for doubtful accounts or a credit balance. And it says in this case that there's a debit balance. Okay. Well, with the income statement method, that actually doesn't matter. With the balance sheet method, it does matter. And with the aging method, it matters as well. So let me try to explain why. If you remember back to permanent versus temporary accounts, the income statement accounts, revenue and expenses are temporary. The balance sheet accounts, assets, liabilities, and the equity accounts that go on the balance sheet, those are permanent accounts, right? So in the balance sheet method, if you're using that method, you have to consider these are permanent accounts that are carrying over from year to year, including allowance for doubtful accounts, because that's a contra asset account. So it carries over from year to year. And you would then have to clear it out. I mean, not clear it out. You'd have to, sorry, another brain malfunction. You'd have to adjust for whatever balance was left in there. And what you do, if there is a debit balance, you're going to add that to your new bad debt. Because basically what you're saying is, we have this amount left over from last year, plus there's this amount we think we're not going to collect from this year. And so together, that's the total amount we think we won't collect from this year. The new estimate plus the amount that we thought was going to be bad debt, but didn't turn into bad debt, but maybe it will later, something like that. Okay, so if that doesn't make sense, don't worry about it. All it means is when we're using the balance sheet or the aging method, and there is a debit balance in allowance for doubtful accounts from the prior period, we add those numbers together. When we're using the income statement method, we just ignore it. So for part C, using the income statement method, it's going to be exactly the same as for A. We just take our net credit sales times our percentage. We just ignore the fact that there is any balance in allowance for doubtful accounts. And again, if you think about it, the income statement method is based on net credit sales, and that's going to get wiped out at the end of the year, right? Because it's a temporary account. So it's like we're starting from scratch every year if we're using the income statement method. That's the best way I can explain it, because that's the only way I understand it. Okay, so then for C, we also need to calculate the balance sheet method. So what we are going to do is take the same 17,568 we used for B because that was the accounts receivable times 3.6% gave us 17,568. The difference is, since there was a previous debit balance and allowance for doubtful accounts, we need to add that debit balance to our new bad debt estimate and journalize the total, 27,788. Okay. So you take your new calculation for bad debt estimate, add it to the debit balance for allowance for doubtful accounts, but again, only if you're using the balance sheet or aging method. And the reason it's balance sheet method or aging method is both of them are based on accounts receivable. So it's the same principle. Now for part D, it's the same thing. We need to first use the income statement method, and then we'll use the balance sheet method. In this case, there's a credit balance in allowance for doubtful accounts. So once again, that does not matter with the income statement method. Our calculation is still the same because we just ignore that credit balance and allowance for doubtful accounts. But with the balance sheet method, we take our original 17,568 that we calculated, and we subtract that credit balance. And that gives us 12,098. Okay, so that's what we journalize if there's a credit balance in allowance for doubtful accounts. All right, so let's double check those numbers. Is that the right thing? Let's see. Oh, I'm on the problem set, right? What am I on? I don't even remember. That was problem 4. Okay. Sorry, I just think I need a nap today is what I need. Okay, that looks right. That is what we calculate. 27,788 and 12,098. Perfect. Okay. So that's number 4. Now we'll do 7, 8, and 11. Okay. This looks a little scary, perhaps, but it's not super bad. So just hang in there. Let me see if I could fit this a little bit better on the page. We're gonna have to scroll one way or the other. Yeah, that's a little better. Okay. All right, we've got 2 companies here, Bean Superstore and Legumes Plus. We have 3 years worth of balance sheets for each company and 3 years worth of income statements. And what we have to do is figure out their AR turnover ratios and their number of days sales and receivables. And then we're going to analyze and see which company we think is the better investment. Okay. So again, what we have to do is take average accounts receivable. I'm gonna go ahead and make this bold so it's easier to see it. Maybe I'll underline it too. And we're gonna divide that into net credit sales, which I will also bold and underline. Okay. So starting with 2018 and then going on to 2019. So for 2018, we're going to first find our average accounts receivable for Bean Superstore. We take beginning and ending accounts receivable, add them together and divide by 2, we get 60,500, right? Then we're going to divide that into net credit sales. 16.27. Did I do that right? $16.27 looks good, okay. We'll do the same for 2019. Again, we need to first get our average accounts receivable, which is in this case, 64,500. Divide that into net credit sales. $15.50. Then we do Legumes Plus for 2018. So we need average accounts receivable. Add them together, divide by 2, we get 80,950, and we divide that into net credit sales. That gives us 12.61 if we round that up. Double check that, but I think that's right. And then the last one here, again, we need our average accounts receivable. $84,050, we divide that into net credit sales. $14.95. Okay, let's double check those numbers. $14.95, we have the 12.61, and we had the 15.5. So it looks like we got that all correct. Yay. So those are our AR turnover ratios that we're going to analyze. For part B, though, we're going to turn that into number of days sales and receivables. Again, we just take 365. Don't know what I hit there, but definitely not the right button. 365 divided by our AR turnover ratio. So that's 22.43. $23.55. $28.95. And last one, 24.41. Okay, let's double check those numbers. $22.43, $23.55, $28.95, $24.41. Good. Okay. So now, which company is the better investment? All right. Well, if we look at their AR turnover ratios, we see Bean is much higher than Legumes, although Bean's slipping a little bit and Legumes is getting quite a bit better. So it's hard to know what, is going to happen in the future, but Bean is still a little bit stronger as far as AR turnover ratio, and they're a little bit stronger here in number of days sales and accounts receivable because it's a smaller number. But again, it's moving in the wrong direction. So if we look at these ratios, that's what we see. Bean's doing better, but Legumes is on track. If they continue with the same progress, they might pass Bean up, in both areas, in both AR turnover and number of days sales. Now, if we look at their overall sales, though, Legumes has stronger sales than Bean. So that's a consideration as well. So which company is the better investment? We could say Bean has better AR turnover and number of days sales in receivables ratios. However, Legumes is showing significant progress and has higher revenues. Also, was it net income? Oh no, that was revenues. Yeah, revenues and net income. Revenues and net income. Okay. So there's our analysis. You know, both companies have pros and cons, but by doing those calculations, it helped us understand the company's strengths and weaknesses. Okay, so that's it for number 7. We have 8 and 11 to go. So for number 8, we are going to calculate AR turnover ratio for 2 years and number of days sales. Okay. So again, we need to add the beginning and ending AR. Divide by 2. Okay, better put that into memory here. And we're going to take our net credit sales divided by our average AR. And it looks like 2.85. Okay, I'm going to clear out the memory. And now let's do 2019. So beginning plus ending divided by 2. Put that in memory. Net credit sales divided by, is that the right number? Yes, it is. Okay. Equals 2.77. Okay, let's double check those. 2.85, 2.77, good. Okay, then we divide each of those by 365. We get 128.07 days here. And for the next year, we get 131.77 days. Let's double check those. Yep, those are both correct. Very good. And what do the outcomes tell a potential investor? Considering that the industry average is 3 for AR turnover and 150 days. So we can say that the AR turnover ratio is lower than the industry average. And it slipped a little in 2019. The number of days sales in accounts receivable is better than the industry average, but that also slipped in 2019, right? Because we went from 128 days to almost 132 days. Again, I can't tell you why we would do better than the industry on one metric and worse on the other. I would think they would actually be correlated, but maybe it has something to do with the size of the companies or the amount that they're owed. I don't know. Never been able to figure that out. Okay, so we are done with problem 8. And if there's no objection, we will go on to our final problem, number 11. Yes, this is another journal entry. So here's a note for $330,700 issued to a client on January 1st. cost of goods sold is this amount. Okay, so we simply journalize that transaction. Then we record interest for the first year. Now, this is a 3-year note, and the customer doesn't have to pay any of the interest until the end. And it's simple interest. So we're going to take the principal times the interest rate, annual interest rate of 4%. So that's $13,228 that we've earned at the end of the first year. Then we earn another $13,228 at the end of the second year. So we now have 2 years worth of interest receivable to collect. And then at the end of the third year, we have a third year of revenue, but it gets paid right at that time. So it doesn't actually become interest receivable because customers already paid it. So we have the third year got paid at the time it became due, but then we had 2 years of interest receivable that had not been paid yet. And so what we see here is there was 1 year that was a credit to interest revenue, 2 years that were the interest receivable from the previous years that had not yet been collected, and then there's the original amount, the principal that was due, okay? So that's how we would journalize it. The principal plus the first 2 years of interest receivable plus the third year, which is just interest revenue. We would add that all together to get the total that the customer owes, $370,384. We'll confirm that amount as well. $370,384. Okay. So that is it. The other problems, go ahead and work on your own. If you have any questions or problems, you can always reach out to me. And that is it. Looks like we're done early today. So any questions here before we go, Jane?
No questions.
Okay, all right. Well, if you catch any other mistakes I made, let me know, but I think you caught them all already, hopefully. So have a good week, and I'll see you next week.
Okay, bye.
Okay, bye-bye.